Welcome to What Would Peter Lynch Do? Today, we're jumping into something that, well, it can really take you by surprise as an investor. We had a listener ask, I suddenly got a stock in my account that I had never seen before because the company I own has spun off. What is a spin-off? Why are they giving me stocks? Is this spin-off company a promising investment?
Yeah, that's a really common situation, and honestly, it can feel a bit bewildering when those shares just pop up. So, our mission for this deep dive is to unpack exactly what's going on there. What is a spinoff? Why does it happen? And the big one, how do you figure out if this new stock is something good? Especially thinking about how Peter Lynch might look at it. Let's get into it.
It's a great topic because, it mixes the practical side of your brokerage account with some pretty significant company strategy. So when you see those new shares, it fundamentally means the company you originally invested in, the parent company, has decided to separate out one of its parts. This could be a subsidiary or maybe just a specific business unit, and that unit becomes a totally new independent company. Okay, independent, so it's not just a division anymore.
Exactly. It stands on its own. Now, this new company, it might get listed separately on the stock exchange, or, like in our listener's case, the shares get handed out directly to the existing shareholders of the original parent company.
Okay, could you maybe give us an example, make it a bit more concrete?
Sure, absolutely. Let's imagine, let's say you own stock in a big company we'll call Pizza Group. Now, Pizza Group isn't just slinging pizzas in restaurants. They've also got this really successful, high-growth pizza delivery app. And maybe they also distribute pizza ingredients. Management looks at this app division and thinks, wow, this thing is flying, the growth is amazing. But maybe they also feel its value is kind of, lost inside the bigger pizza group structure.
Right, it's not getting the attention it deserves, maybe.
Precisely. So they decide to spin off this app division. It becomes its own separate company. Let's call it Pizza Delivery App Co., Ltd. Now, it's not just a part of Pizza Group. It's a standalone business.
Okay, that makes sense. So, back to the shares just appearing. Why do I, as a shareholder of Pizza Group, suddenly get shares in Pizza Delivery App Co? It feels like free stock, but I suspect it's not quite that simple.
You're right. It's not exactly free in the usual sense. You get those shares because you already owned a piece of the original company, the Pizza Group. When a spinoff happens like this, the standard way is to distribute shares of the new company, Pizza Delivery App Co., in our example, directly to the people who already hold shares in the parent. And yes, you don't pay extra for them at that moment.
So it's like a different kind of dividend.
You could think of it like an in-kind dividend, yeah. Or maybe better, just think of it as restructuring the ownership you already had. Your original investment in Pizza Group represented ownership in all its parts, including the app business. Now that ownership is just being split into two separate shareholdings, one in the remaining Pizza Group and one in the new Pizza Delivery App Co., Ltd.
Okay, got it. My ownership stake just got reconfigured. So now for the million-dollar question our listener asked. Is this new spin-off company actually a promising investment? Should I be happy it landed in my account, or should I be looking to sell it quickly?
That really is the crucial question, and the honest answer. It's completely case by case. There's no automatic rule saying a spinoff is good or bad. You really have to dig in and weigh the potential upsides against the possible downsides.
All right, let's start with the positives then. Why might this new stock actually be a good thing?
Okay, several potential advantages. A big one is enhanced specialization and business focus. The new, separate company can now pour all its energy and resources into its specific business. Our Pizza Delivery App Co. can focus purely on making the app better, getting more users, marketing itself without worrying about the pizza ingredient side of things.
Right, laser focus. No distractions from the parent company's other businesses.
Exactly. This focus often leads to faster decisions, more innovation, just generally being more efficient in its niche.
Okay, what else?
Second, spin-offs can be fantastic for highlighting hidden value. Sometimes you have a really valuable part of a business, but it just gets overlooked because the parent company is so big or maybe operates in a less exciting industry. When it spins off, it gets its own valuation from the market. Its true potential can finally be seen. That innovative tech in the Pizza Delivery App Co. might suddenly attract a much higher valuation than it ever could as just a division of Pizza Group.
Ah, so it steps out of the shadows. Makes sense.
Third, you often see increased management efficiency. The leaders of the new independent company have clear accountability. Their strategies can be tailored specifically to their operations, not compromised by the needs of the wider parent group. And fourth, it can become easier to attract new investors. Maybe the original pizza group is seen as a stable, slow-growth food company,
Hmm.
but the Pizza Delivery App Co. is a tech play. Spinning it off allows it to attract tech investors, venture funds, people who wouldn't have touched the parent company.
Those all sound like pretty compelling reasons for a spin-off to do well. But I'm guessing there's another side to this coin. What are the risks?
Oh, absolutely. You definitely need to be aware of the potential downsides. First off, there's often initial instability. Starting out on its own, the new company has to set up its own systems, maybe its own HR, finance, IT infrastructure. There can be some bumps in the road early on.
Growing pains, basically.
Yeah, exactly. Second, there can be a real financial burden. It might lose the financial safety net of the parent company, or sometimes the parent saddles the spinoff with a chunk of debt on its way out the door. That could really strain its resources from day one.
Ouch, starting off in debt doesn't sound ideal.
Not at all. Third, there's a potential loss of economies of scale. Things that were cheaper or easier as part of a huge corporation like bulk purchasing, maybe shared administrative costs might become more expensive for the smaller independent company. Efficiency could drop in some areas. And this last one is really, really important. You have to look hard at the reason for the separation. Why did the parent company do this? Sometimes, honestly, it's because the unit being spun off is struggling. It's a problem child.
So they're just trying to get rid of it.
Sometimes, yes, they cut their losses by spinning it off. If that's the case, the shares you just received might actually be, well, junk. You have to investigate the backstory. Was the spinoff motivated by unlocking growth and value, or was it about dumping a poorly performing, perhaps debt-laden business? That distinction is critical.
Okay, that's a really clear picture of the potential pros and cons. It definitely sounds like you need to do your homework. Now, thinking about Peter Lynch, he was often pretty wary of things like IPOs. How do you feel about spinoffs? Was he equally cautious, or did he see them differently?
That's a great point. And interestingly, Peter Lynch had a very different view of spin-offs compared to IPOs. While he was often skeptical of initial public offerings, he actually described spin-offs, in his books and talks, as potentially very promising investment opportunities.
Really? So quite the opposite of his IPO stance. Why the enthusiasm?
Well, Peter Lynch saw a few key things in spin-offs that really appealed to him. First, he saw that hidden gem potential we talked about. He famously called these units things like great small companies trapped inside giant corporations. He believed these potentially high-growth businesses were often just buried, undervalued within the parent company structure. The spinoff was the moment the market could finally discover their true worth.
So a classic Lynch turn over the rocks opportunity.
Exactly. Finding value where others weren't looking closely. Second, he really liked the management motivation angle. Once spun off, the management team of the new company is directly in the spotlight. Their success, their compensation, it often becomes much more tightly linked to how the spin-off stock performs. That creates powerful incentives.
Skin in the game, basically.
Right. Third, it comes back to that enhanced specialization and focus. Lynch was big on companies sticking to what they do best. He believed that when a spun-off unit could focus 100% on its core business, it could really maximize efficiency and allocate resources much more effectively than when it was just one part of a conglomerate. And maybe one of his most insightful points about spin-offs was his observation about shareholder indifference.
Ah, I think I've heard about this one.
Yeah, Lynch noticed that when these spin-off shares land in the accounts of the parent company's shareholders, some of those shareholders just don't know what to do with them. They're unfamiliar with this new company, maybe it doesn't fit their original investment thesis for the parent. So what do? They often just sell it, sometimes without much analysis. Peter Lynch famously said it can be a better stock precisely because people don't want it. He saw this selling pressure as creating a temporary undervaluation, a perfect buying opportunity for investors who did do their homework. It was bargain hunting 101 for him.
That's brilliant. Such a classic Peter Lynch contrarian way of thinking. But knowing Lynch, he wouldn't just buy any spin-off, even if he liked the concept. He must have had criteria, right? How did he judge them?
Oh, absolutely. He wasn't advocating blind investment at all. His enthusiasm was always paired with a call for rigorous analysis. First, thorough analysis was key. You had to really dig into the spin-off's business model, its financials. Could it actually survive and thrive on its own? Was it financially sound? Second, management verification. He'd want to know, is this new management team capable? Do they have a clear plan? Are they the right people to lead this newly independent company? And third, it always came back to his core principle, invest in what you know. He'd focus on spin-offs where he could actually understand the underlying business. Is it a retailer? a restaurant chain, something related to technology he used or understood. That familiarity was crucial.
So he saw potential, but only if the fundamentals checked out and you understood what you were buying.
Precisely. For Peter Lynch, spin-offs were a hunting ground for those hidden gems, yes. But it required serious homework, understanding the business, and importantly, taking a long-term view.
Okay, so Lynch was optimistic, with caveats. What about the real world? Does the data actually back up this idea that spin-offs tend to do well? How do they generally perform in the U.S. market?
That's the critical question, right? Moving from theory to actual results. And generally speaking, the data does lend support to the idea that on average, spin-offs tend to outperform the broader market, particularly in the period after they become independent. But I have to stress that word, average. Individual results vary wildly. But let me give you a couple of interesting data points. There was a study by J.P. Morgan Research back in 2012. They looked at U.S. spin-offs from 1985 all the way to 2011. What they found was pretty striking. On average, these spin-off companies delivered returns that were 20 percentage points higher than the S&P 500 index in just their first 12 months of trading independently.
20 points higher in the first year. Wow.
Yeah, pretty significant outperformance. The thinking is that this reflects the market quickly reevaluating the company's potential once it's free from the parent. And there was another study, this one by Richardson and Rowland in 2007, covering 1985 to 2004. They found that spin-offs achieved an average annual outperformance of about 10% over the first 3 years after separation.
So sustained outperformance in that case, too.
It suggests that. The implication seems to be that maybe these companies are initially overlooked or undervalued, perhaps due to that shareholder indifference Lynch talked about. But then, over time, as they establish their independence, improve efficiency, and execute their strategies, the market tends to recognize their value.
And I seem to recall hearing that sometimes even the parent company benefits.
That's right. Some research suggests positive effects for both. The parent company gets to streamline, focus on its core operations, maybe shed some complexity, and the spin-off, as we've discussed, gets its independence and growth potential unlocked. A fairly recent example people might recognize is General Electric, GE. They've been undergoing a major transformation. In 2023, they spun off their healthcare business, now GE Healthcare, and then just this year, 2024, they spun off their energy businesses into GE Vernova.
Right, I remember reading about that.
The idea for GE is to become a much more focused company, primarily centered on its aviation business. Meanwhile, GE Healthcare and GE Vernova aim to thrive as independent players in their respective fields. The initial market reaction seemed pretty positive, but obviously their long-term success stories are still being written. So what tends to make a spin-off successful? Usually it's things like having that clear business focus, a strong management team ready to go, solid enough financials to stand alone, and operating in a market with decent growth opportunities. But, and this is the big warning label again, these are averages. Not all spin-offs are winners. Many underperform or fail, especially if it really was the parent just cutting its losses and spinning off a weak, indebted, or struggling unit. Those are the traps you need to avoid.
That warning is definitely landing. It really sounds like telling the difference between a hidden gem spinoff and one that's just, well, being dumped is the hard part for us regular investors. We don't have those boardroom meetings. The SEC filings look like Klingon half the time.
Yeah, it absolutely is challenging. There's definitely information asymmetry, as they say. Institutions often have more access, more resources to analyze these situations.
So how can we as individual investors approach this wisely? Is it just too hard, or are there practical steps, maybe following Lynch's spirit?
It's definitely not impossible. Challenging, yes, but doable with the right approach. First, you have to try and decode the documents. Those official filings companies make when they spin off things like a Form 10 or an S-1 filed with the SEC, they are dense, no doubt about it. But think of them as your main source of clues, maybe like a treasure map, albeit a complicated one. You need to dedicate some time, maybe use online resources to help understand the key sections, the description of the business, the risk factors, the management discussion, and crucially, the financial statements.
So grit your teeth and dive into the official paperwork. What are you looking for specifically?
You're looking for the why. Does the company clearly state a positive rationale for the spinoff? Like focusing on core businesses, unlocking value? Or is the language vague, or does it hint at maybe shedding debts or a low-growth division? Read between the lines of the official statements. Second, lean into Peter Lynch's big one. Invest in what you know. If a company you already own stock in, or maybe a company's products you use every day, spins off a division, you might have a better starting point for understanding it. If it's in an industry you work in or follow closely, even better. You might spot the potential or the pitfalls faster than someone just looking at numbers. Spin-offs don't usually happen overnight, so just keeping an eye on the companies you already hold is important.
Use your own experience as an edge.
Yeah.
Okay. How do we actively try to sort the good from the potentially bad?
Right. You need to try and identify the characteristics of attractive spin-offs versus the cut-loss ones to avoid. What makes one look attractive? Usually, it's a business unit that has strong growth potential, but was perhaps held back by the parent. You'd hope to see signs of increased management efficiency after independence. Ideally, it starts with low debt, maybe even some cash from the parent. And of course, a capable new management team with a clear strategy.
And the ones to avoid?
Avoid the ones that look like the parent's problem child, maybe loaded with debt, consistently low profits. Be wary if it seems highly dependent on the parent company for its business, making true independence difficult. Or if it's in an industry that's clearly stagnant or declining. The key questions you have to keep asking are, why exactly is this being separated? And will it realistically be stronger and better off standing on its own?
Why is it being separated and will it be stronger? Got it.
Fourth, and this is crucial given the initial volatility, maintain a long-term perspective. Spin-off stocks can bounce around a lot, especially early on as the market figures them out and initial shareholders sell. But the real value, if it's there, usually emerges over time as the business finds its footing and starts executing its plan. Peter Lynch favored spin-offs partly because he was a long-term investor looking for that hidden value to eventually be recognized.
So patience is key. Don't get spooked by early wobbles.
Exactly. And finally, use expert opinions as a reference, but don't blindly trust them. Read analyst reports, see what the professionals are saying. Sure, that's valuable input. But remember, they're not always right. Sometimes your own understanding of the business, your on-the-ground perspective, might give you insights they've missed. So look, it is tough for individual investors to do the same deep dive as a Wall Street pro on every spinoff. But it's not impossible to find good opportunities. It's about being selective, focusing on finding meaningful information amidst all the noise, using your personal advantages like your own knowledge and a longer time frame, and always managing risk. This kind of studying, as Lynch would call it, it's about more than just numbers. It's about interpreting the situation, seeing through the corporate actions from your own perspective. That really echoes Peter Lynch's advice throughout his career.
That's a really empowering way to think about it. It's not about having all the answers, but about asking the right questions and using your own judgment. You know, what's fascinating here, Peter Lynch's emphasis on digging deep, on understanding the why behind something, and spotting that hidden potential that feels like it's bigger than just investing.
I completely agree. It really is a principle that connects not just to investment decisions, but I think to broader life wisdom too. I mean, in life generally, right? You often have to look past the surface of things. You need to try and understand the underlying motives, whether it's in people or situations. And you need to recognize that sometimes the very things that other people dismiss or overlook might actually hold significant untapped value or potential.
Like finding the hidden gem in everyday situations, not just in the stock market.
Exactly. Just like a spinoff might reveal a great business that was hidden, sometimes looking closer at an unassuming situation or opportunity in your own life, with that same curiosity and diligence applied to stocks, might reveal something really valuable.
That's a powerful thought to end on, looking beyond the obvious in our portfolios and maybe everywhere else too. Thanks so much for walking us through that. And thanks to all of you for joining us for this deep dive. We'll see you next time on What Would Peter Lynch Do? Have a nice day.